In this video, we'll first take a look at the industry chain of the photovoltaic sector, and then explore which segment might be more suitable for small-scale investments. The upstream segment of the photovoltaic industry primarily revolves around the production of silicon-based raw materials, including silicon feedstock and silicon wafers. The midstream segment focuses on the manufacturing of photovoltaic cells and modules. The downstream segment, in simple terms, can be understood as power stations. In the upstream segment of the industry, silicon feedstock is the most fundamental raw material for the photovoltaic sector, with China accounting for over half of global production capacity. This dominant market position has created significant economies of scale, making it difficult for small new entrants to compete in this field. After processing, silicon feedstock is transformed into silicon wafers. The mainstream trend in the wafer industry is to increase product dimensions to reduce costs. Similar to the silicon feedstock sector, the silicon wafer industry is also highly concentrated and not particularly welcoming to new players. Now, let's move on to the midstream segment. Photovoltaic cells can generate voltage under sufficient sunlight and produce current when connected in a circuit. Due to the high degree of technological homogeneity and relatively low technical barriers, the midstream segment differs from the upstream. Its market concentration is lower, and competition is more fragmented. However, this also means weaker bargaining power with both upstream suppliers and downstream buyers, resulting in lower profit margins. Photovoltaic modules, also known as solar panels, are manufactured by connecting battery cells in series or parallel, encapsulating them and assembling additional auxiliary materials. The module industry is labor-intensive, with relatively high market concentration but similarly low profit margins. Photovoltaic modules consist of solar cells and auxiliary materials, such as frames, glass, encapsulant films, backsheets, and other components. The combined cost of these auxiliary materials is nearly equivalent to that of the solar cells themselves. However, due to the wide variety of these materials, they fall outside the scope of our current analysis. To summarize, the midstream segment of the industry offers relative stability but suffers from low profit margins. Finally, let's discuss the downstream segment. The end product of the industry is the photovoltaic power station. A PV power station is constructed by assembling modules into solar arrays, which are then connected to inverters for converting DC to AC, switchgear, and a central control system, forming a fully operational power plant. Similar to traditional power plants, PV stations are categorized into two types: centralized and distributed. Utility-scale PV plants require massive investments, often costing tens of millions of dollars, making them inaccessible for most individual investors. These are typically built in China's vast western regions. Distributed PV systems, on the other hand, involve much smaller capital outlays. They allow for on-site electricity consumption, with any surplus fed back into the grid for additional revenue. Which segment of the PV industry is suitable for small-scale investment? Let's summarize our earlier analysis. First, upstream, silicon feedstock and wafers, highly concentrated market, unsuitable for small investors. Second, midstream, PV modules and cells. Module production is also dominated by major players, while cell manufacturing has lower barriers but suffers from thin profit margins. Third, downstream, PV power stations. Utility-scale plants offer stable returns but require prohibitively high capital. Distributed PV systems, however, involve smaller investments and appear more feasible. But is this segment truly viable for individual entrepreneurs? Let's dive deeper. Distributed PV systems are typically deployed on rooftops of factories, hospitals, schools, and other buildings with ample roof space. By generating electricity on site, these systems allow businesses to reduce grid purchases. Excess power can be sold back to the grid, creating additional revenue, a model known as commercial and industrial distributed PV. Let's talk about key considerations for C&I distributed PV. First, partner selection. The biggest hurdle is securing reliable corporate partners. A stable, long-term business with consistent electricity demand is critical. If the partner's operations decline or fail, their power consumption drops, directly impacting the project's profitability. Second, roof requirements. The roof must meet structural, size, and orientation standards. For example, sufficient area, south-facing tilt, load-bearing capacity. Avoid shading from nearby buildings, dust, or obstructions that reduce sunlight exposure. Resilience to extreme weather, hail, storms, etc., is also crucial. Then let's talk about residential distributed PV. Households can adopt a similar self-consumption plus surplus grid sales model. Typical capacity, 10Q, requiring 8100 m of roof space. Alternative sites. Non-arable land or hillsides can also host PV systems, though these usually rely entirely on grid sales rather than self-use. A PV power station typically operates for 25 years. Investors have two options. First, long-term ownership. Gradually recoup costs and earn profits over 25 years. Second, early exit. Sell the project to another investor for quicker capital recovery. In our next video, we'll focus on the long-term ownership model, more accessible for individual investors, and conduct a detailed cost-benefit analysis. Stay tuned. If you're considering a venture in China, reach out via email. We're a consultancy specializing in business analysis. bizchinapanda@gmail.com